Good morning and welcome to Weekly Insights with John Plassard by Cité Gestion. As economic statistics keep being revised, upward one day, downward the next, anticipating cycle really rests on two pillars: corporate earnings and the signal sent by central bankers. And on this second point, one element has been largely underestimated but will matter a lot in the second half of 2025: preemptive cuts. Just over a month ago, I reminded you that the Fed only cuts rates in two scenarios, either to respond to a shock or a recession, or preemptively. And some weeks ago, Jerome Powell made it clear this time the Fed chose the second option. He called it a preemptive risk management cut, a phrase that says it all. The US economy is not in crisis, growth is still positive, inflation is not spiraling out of control. Yet the Fed moved, not because it had to, but to avoid a sharper downturn later. So what exactly is a preemptive cut? It's often called an insurance cut. It means lowering rates before a recession is confirmed to neutralize the first cracks in the system. The Fed has done it before, in 1995 and 1998, when early cuts helped to contain turbulence before it turned into something bigger. The logic is simple. It's better to ease slightly while the patient is still healthy than to wait until the hospital is full. But credibility is everything. If the cut looks too timid, markets will think the Fed is in denial, and if it looks too aggressive, inflation fears resurface. And the real trigger here is the labor market. For months, US job creation has been slowing. In August, only 22,000 new jobs were added, a dramatic fall from previous trends. Even worse, a massive revision erased nearly 1 million jobs from last year's statistics. That was the shock that convinced Jerome Powell. The Fed decided to act before job losses turned into a structural slide. Of course, the timing raises eyebrows because inflation is still above the 2% target. Core inflation remained sticky around 3%. Normally, this would argue against easing, but Jerome Powell emphasizes that long-term expectations remains anchored and that services inflation is moderating. In other words, he's willing to tolerate slightly too high inflation to avoid far too weak employment. That's a delicate balancing act. Market reactions? Historically, preemptive cuts have boosted equity, especially growth stocks and technology. Bonds also tend to perform well, particularly treasuries and investment grade. The dollar often weakens, while safe havens like the yen and the Swiss franc strengthen. Volatility usually spikes because markets struggle to interpret whether the Fed is acting out of strength or out of fear. Politically, the move is also sensitive. Donald Trump has been pressing for deeper and faster cuts, and Powell insists the Fed remains independent. But the optics are tricky. Is this genuine risk management or political compromise? That perception risk is one of the Fed's biggest challenges. Looking ahead, the so-called dot plots show that most Fed officials expect further rate cuts later this year and into 2026, but at a gradual pace, not the sharp easing that the White House wants. This confirms the Fed is entering a new area of preventive policy. It won't wait for the storm, it wants to act at the first signs of rain. In conclusion, Powell's move is a turning point. This is not crisis management, it's risk management. And for investors, that means navigating more volatility, more uncertainty, and a Fed that is both pragmatic and unpredictable. The age of preemptive cut has begun. Thank you very much. Have a great day. Stay safe and keep on winning.